You know, while it feels like the rest of the world is pumping the brakes, there's one sector in India that's absolutely hitting the accelerator: steel. So today, we're going to dive deep into the three titans of the industry: JSW Steel, Tata Steel, and Jindal Steel Power, to figure out how they are building their future in, well, a pretty chaotic global economy.
Right, so this is really the big question, isn't it? With major economies facing a slowdown, how on earth is India's steel industry not just surviving but actually booming? What's their secret? Well, let's get into it and find out.
Okay, here's our game plan. First, we'll look at the big picture with India's steel decade. Then we'll put our three titans head to head. After that, we'll talk about the risks and the headwinds they're up against. And finally, we'll look ahead and see what the future holds. All right, let's start with section 1. The story of Indian steel right now is really a story about what's happening at home. While the global market is, let's say, unpredictable, India's internal growth is creating this incredible opportunity for these steel giants. Just look at this number, 8.9%. That is the projected year-on-year growth for India's steel demand in 2025. I mean, in a world where growth is hard to come by, India is pretty much the only game in town for the steel industry. It's the undisputed bright spot.
So you might be asking, where is all this demand coming from? Well, it's a perfect storm, really. You've got massive government infrastructure projects, a huge push for housing, and an auto sector that's back on its feet. All of this together is creating what some are calling a steel supercycle. And the government has another card up its sleeve: safeguard duties. Think of it like a protective wall. It shields domestic steelmakers from a flood of cheap imports, which helps keep their prices and profits stable, allowing them to reinvest in expansion, even when global markets are weak. Okay, now for the main event, let's meet our three titans. Now, they're all competing in the same arena, but believe me, they each have a very, very different strategy for winning. All right, so let's get a quick snapshot of where they stand. You can see right away, JSW has the largest market cap, but that's not the whole story. The PE ratios and those one-year returns hint that there's a lot more going on under the hood. So let's dig a little deeper.
First up, JSW Steel. If you had to describe their strategy in just a few words, it would be all about scale. It's a pure volume play. They are laser-focused on one thing: getting bigger. They want to expand their capacity to drive down costs and just dominate the market through sheer size. And to give you an idea of their ambition, look at this number: 51 million tons per year. That's JSW's production target for 2031. This isn't just about steady growth. This is a plan for total market leadership. Now, when you look at their financials, you can see the strategy in action. The revenue is, of course, massive. But take a look at that net debt to EBITDA ratio. At over 3, it's on the higher side. And that's the trade-off. To fund this aggressive expansion, they're taking on a lot of debt. So for JSW, it's all about this balancing act. Their biggest strength, without a doubt, is their incredible scale. And they're smart. They're securing raw materials overseas to control costs. But the flip side is that mountain of debt, which makes them pretty sensitive to interest rate hikes. It is the definition of a high-risk, high-reward strategy. Okay, next up is Tata Steel. And their story is completely different. They're running what I like to call a dual-engine strategy. On one hand, you have their insanely profitable Indian operations, and on the other, you have this huge, complex, but really important green transformation happening in Europe. And this number, this is the powerhouse, 22%. That's the EBITDA margin for their Indian business. It's a cash-generating machine, and it's this engine that's paying for the company's massive pivot to green steel over in Europe. When you look at the consolidated numbers, you can really see this dual strategy playing out. The revenue and EBITDA are incredibly strong, no question. But that net debt figure is also pretty hefty, and a lot of that is tied to their European assets and the huge investments they're making there. So to sum up Tata's position, their superpower is their Indian business. It's fully integrated, meaning they own their iron ore mines, which protects them from price swings, and of course the brand is legendary. The weak spot, historically, has been Europe. So their entire strategy is about using the strength of one to fix the weakness of the other. And that brings us to our third titan, Jindal Steel Power, or JSPL. Now these guys are playing a totally different game. They're not chasing the massive scale of JSW, and they're not juggling a global empire like Tata. Instead, their entire focus is on efficiency, financial strength, and dominating specific high-value product categories. And this number right here, this tells you everything you need to know about their strategy. A net debt to EBITDA ratio of just 1.48, that is an exceptionally strong balance sheet. It gives them flexibility and makes them nimble, able to jump on opportunities while their competitors might be tied down by.
Their financials really reflect this focus on quality over quantity. Yeah, the revenue is smaller than the other two, but just look at that operating margin, 19%. That's the result of being a leader in high-value products like railway steel and keeping a really tight grip on costs. So when you look at JSPL, the strength is crystal clear: a rock-solid balance sheet and leadership in profitable niches. Historically, their challenge has been dealing with regulatory issues and project delays. And like almost every steelmaker, they're still exposed to the ups and downs of the global coking coal market.
Okay, so we've covered a lot of the good news. But of course, it's not all blue skies and smooth sailing. It's time to talk about the storm clouds that are definitely on the horizon. You can really split these risks into two buckets. On one side, you have the big macro risks that affect everyone, things like volatile commodity prices and a global slowdown. And on the other side, you have risks that are unique to each company, like Tata's European project, JSW's massive debt, or JSPL being heavily tied to the construction market.
And this quote from analysts at Antique Stockbroking really hits the nail on the head. Even with incredible domestic demand and those government protections, India doesn't exist in a vacuum. Weak global prices will always put a cap on how high domestic prices can really go. It's a constant tug of war. So, after all that, where do we stand? Let's tie it all together and take a look at what the future might hold for these three steel giants. What's become really clear is that we're looking at three companies building three very different kinds of competitive advantages or moats. JSW is building a fortress of pure scale. Tata is leveraging its powerful brand and its Indian profit engine to fund a green future. And JSPL is the efficient specialist building its moat on financial strength.
And you know, one of the most interesting shifts we're seeing is how going green is changing from just a cost or a burden into a real strategic advantage. You see it with Tata's enormous investment in a new furnace in the UK and JSW's moves into green hydrogen. They are all betting that in the future, customers will pay a premium for clean steel. Okay, so let's wrap this up with the key takeaways. First, the India growth story is real and it's powerful. Second, in a volatile world, controlling your own raw materials is absolutely critical. And third, right now, many analysts seem to favor Tata and JSPL for their strong domestic focus. And of course, a quick reminder, this is for educational purposes only and is not financial advice. So, we end up back where we started, but hopefully with a much clearer view. You've got the scale player, the legacy brands turning green, and the nimble specialist. Each one has a compelling but very different bet on the future. The billion-dollar question is, which strategy will ultimately win out in building the India of tomorrow? Well, only time will tell. Thanks for joining me.